Okay, listen up. We are diving into this explainer today to tear down the absolute biggest lie you've ever been told about real estate. You know the one. Just buy a house, sit on a beach, and watch the cash roll in. It's pure fiction, a complete myth. Today, we are tearing that down with cold, hard math.
Think about it. If you're buying a house and just praying for the market to magically go up, you are not investing. You are gambling. You are literally walking into a casino with your life savings, putting it all on red and hoping for the best. And let me tell you, hope is not an investment strategy. History proves this, right? Look back at the early 2000s. People were scooping up terrible properties that bled money every single month. Why? Because they convinced themselves they could just sell them for more later. They were playing in the world's largest game of legalized gambling, and they lost. Badly. That blind, reckless optimism is exactly what triggered the 2007 housing crash and over 4 million foreclosures.
All right, Section 1, the 4 real estate generators. Real estate actually has 4 distinct engines that build wealth at the exact same time. First up is cash flow. That's the actual money left over after every single bill is paid. Engine 2 is appreciation. But hear me out. Treat this as the icing on the cake, not the main course. Engine 3 is tax savings. The government literally rewards you with tax breaks just for providing housing. And Engine 4 is loan paydown. Your tenant is out there actively paying off your debt for you. Amateurs, they obsess over engine number 2. But the pros, they fire up all 4 at once. The difference here is totally stark. Amateurs rely on a buy and pray strategy. Their only source of profit is market appreciation, which pushes their risk level to extreme. It's gambling. Professionals, on the other hand, use a buy and manage approach. They engineer profit from all 4 generators we just talked about. Their risk is calculated. It's time to stop acting like an amateur. Moving to Section 2, the BRRR strategy blueprint. Enter the BRRR strategy. Buy, rehab, rent, refinance, repeat. This right here is the ultimate wealth hack. You are basically using short-term money to buy a fixer-upper, forcing the property's value up through strategic renovations, and then you force the bank to pay you back. It is a calculated, totally repeatable loop. Let's break that down. Step 1, buy. You've got to find a deep discount on a broken asset. Step 2, rehab. But we're talking durable fixes here. Think indestructible waterproof flooring, not those expensive hardwoods that a tenant will instantly wreck. Step 3, rent it out to reliable people. Step 4, refinance. This is the absolute secret sauce. You pull your initial cash right back out through a new bank loan. And then step 5, repeat. You literally recycle that exact same stack of cash to go build an empire. Next up, Section 3, doing the hard math. Let's say you're looking at a standard property. Call it 123 Main Street. If you don't know exactly how much money a deal like this is going to make, the literal second you buy it, it is a bad deal. Walk away. You make your money when you buy, not when you sell. You can't just guess here. You have to calculate. And here is a brutal reality check for you, the 50% rule. Assume half of your rent instantly vanishes to operating expenses. I mean, instantly. Vacancies, property taxes, insurance, and the basic fact that toilets just don't fix themselves. Half your income is gone before you even touch your mortgage. If the math doesn't work after slashing your gross income right down the middle, do not buy it. So what metric actually tells you if a deal is good? Cash-on-cash return. Forget all the complicated academic jargon. This is the only number that tells you exactly how hard your specific out-of-pocket dollars are working for you. It's just your annual cash flow divided by the actual cash you invested. Look, if this number is lower than what you'd get from a lazy, simple index fund, why on earth would you take on the headache of real estate? You have to demand a high return. Which brings us to the massive debate, all cash versus leverage. Buying with all cash definitely feels safe, lower risk, right? But it completely traps your capital and it crushes your potential returns. Leverage is the magic multiplier. It frees up your cash so you can buy way more assets. But, and this is a huge but, over-leveraging is exactly what destroyed people in 2008. Leverage is a weapon. You can use it to build, but you cannot let it blow up in your face. All right, Section 4, the 1031 exchange loophole. Enter the 1031 exchange. This is the completely legal loophole that the ultra-wealthy use to dodge taxes indefinitely. Seriously, say in year 1 you invest 50 grand. By year 10, you sell. But instead of handing the government a massive cut of your profits, you rolled the entire amount directly into a bigger property. Fast forward to year 35, you've traded your way up to a multi-million-dollar commercial portfolio. You legally defer those taxes forever, all while your wealth just aggressively compounds. It's mind-blowing. And finally, Section 5, the fatal flaws of the perfect model. Now, time for a reality check. Most real estate models build their flawless wealth projections on a steady, guaranteed 3% annual appreciation. But come on, real life doesn't move in a straight line. Markets crash, they stagnate, they swing wildly. Relying on a perfectly smooth, upward growth curve is just a massive analytical failure. You have to prepare for the years when that growth drops below zero, because it will. Then there is the 70% ARV myth. The entire burst strategy we just talked about, it assumes you can easily go out and find properties for a 30% discount. Let me be crystal clear here. Finding a massive, deep value discount is not some casual weekend hobby. It takes relentless marketing, ruthless negotiation, and serious grit. These deals do not just magically fall into your lap. And we absolutely cannot ignore the systemic risks that these perfect models conveniently leave out, like strict bank loan caps suddenly cutting off your funding, or a hidden $10,000 plumbing nightmare lurking right behind the drywall. How about nightmare tenants who completely trash your property? Or getting caught underwater on heavily leveraged homes? Guys, a single bad tenant can literally wipe out a full year of profit in one weekend. So the most crucial, totally counterintuitive takeaway from all this source material is this. You can actually go broke buying good deals. Yes, you heard me right. Scaling too fast or ignoring those hidden systemic risks we just talked about can absolutely bankrupt you. Even if your initial spreadsheet looked absolutely flawless, your math has to account for disaster.
So, what's the bottom line? Are you ready to stop gambling on appreciation and start doing the brutal math? The path to financial freedom is not a magical beach vacation. It is a cold, calculated math equation. The rules are clear, but the risks are very, very real. So the next time someone tries to tell you that getting rich in real estate is easy, just ask them to show you their spreadsheets. The real question is, are you ready to solve yours?